Hello, my name is Andrew Liu and I'm the Director of Capital Markets for CFI. I'm delighted to be teaching you this course on Economics for Capital Markets. The reason that this course is called Economics for Capital Markets is that this course is not meant to give you the classic textbook lessons on micro and macroeconomics full of equations and supply-demand charts, but rather to give you really useful things to know about economics as to equip you for a career in the financial markets. For me personally, it was a rude awakening on my first day working on an investment bank trading floor, thinking I was well armed with my degree in economics, only to realize that traders and clients were mostly concerned about how to profit from the impact of economics on the market, rather than worry about economic theories. We had teams of professional economists, much smarter than me, whose only job was to slice and dissect the tons of data and models as to try and make sense of those things using traditional economic principles. Hence, what we shall go over together in this course is what I learned in my nearly 20 years working in the capital markets to be really important concepts to understand and apply when one works in the markets. At the end of this course, you will know how economics impact financial markets. You'll understand central banks and their role in the economy. You will classify and be able to interpret economic releases, as well as understand how specific economic news impact specific markets. And lastly, you'll know how market practitioners use this information to trade or invest. So on to the first topic, and that's economic events. Broadly speaking, economic events are news that tend to move markets, and as I alluded to earlier, both the buy side and sell side care most about how and when markets will move in order to make their investment decisions. So what specifically is an economic event? I like to classify economic events as the release of economic indicators or economic releases to the general marketplace. In theory, the information should be made available to all market participants at the same time. However, in reality, there can sometimes be leaks from a variety of sources. But for the point of our discussion here, let's just assume that information is perfect and that all participants receive the information at the same time. Economic indicators tend to be more objective and generally have some sort of numerical representation. Examples of economic indicators would be something like GDP, gross domestic product, or CPI, consumer price index, a measure of inflation, or even a central bank rate decision. Economic releases, on the other hand, tend to be more subjective and would be news-based. These sort of economic events may require more of a deep dive to interpret the tone of the speaker or the message between the lines. An example would be the chair of the Board of Governors of the Federal Reserve Board or the president of the European Central Bank speaking to reporters in a press conference. We will go into more detail on both economic indicators and economic releases in later slides. While economics is key to finance, micro and macroeconomic theories don't move markets by themselves. Traders, investors, and speculators need something real-time so that they can quickly formulate investment strategy, time their trades, and also use market volatility or lack thereof to make bets. Economists also need live data to update models and forecasts. All of these inputs come from economic events. To use one of my favorite quotes, in the long run, we're all dead, by John Maynard Keynes. We'll talk a bit more about him later when we discuss monetary policy. Economic events aren't always 100% accurate, but in a perfect world without any other overarching news, geopolitical tensions, terrorist incidents, or trade wars, without any conflicting news or data, without any specific industry news, or without any security-specific news such as earnings, credit upgrades or downgrades, or analyst forecast changes, economic events will drive the market. The foreign exchange, FX, and fixed income markets tend to react more directly to economic news than the equities or commodities markets. Equities markets are dependent on specific company and industry fundamentals, while the commodities market depend largely on more geopolitical and weather events. As we mentioned before, economic events can be both qualitative and quantitative. Both are equally relevant. Figures don't lie, but they're often open to interpretation and adjustment or modification in the future. Subjective or qualitative releases often require a deeper dive. And there are some economic releases, such as Purchasing Managers Index, or PMI, which take a qualitative measure, business sentiment, and quantify it as an index, which is an objective figure. Now you may ask where we get all this information from. Many of these economic events are from official agencies or sources, but there are also economic events from quasi-official or even private entities, such as the University of Michigan, Case-Shiller, or ADP. This is important for us when we consider the source of the economic news. Let's go back and focus on economic indicators for a moment. As you will recall, economic indicators tend to be more numbers-based. So the numbers generally fall into three measures. The first of which is volume. That's generally a quantity such as barrels of oil or numbers of homes sold. Second type of number we'll see is price. And that's a market price of that thing, say the price of a barrel of oil or the consumer price index. Lastly, we'll see the market value of something, say production of oil over a year or set of interest rates. The relationship between these three types of figures can be captured in a very straightforward formula, where volume times price equals value. Other things to consider when looking at economic indicators would be whether the figure is absolute, whether it's an index, or whether it's a time series, which means that it changes over time, say year over year. Lastly, many figures use moving averages and/or seasonal adjustments to smooth out the data and to take out erratic moves. Economic indicators can be largely classified into three broad categories based on the expected time frame the specific indicator is referring to, namely data from the past, the present, or potentially from the future. For economic indicators that provide an expectation of what's to come, we call those leading indicators. These indicators are any economic factor that changes before the rest of the economy begins to go in a particular direction or foretell something in the future. Examples of these would be, say, confidence surveys, housing starts, or durable goods orders. All three of these indicators give market participants and economists a sense of what the economy may look like in the future. For economic indicators that provide indication of what's happening now, we call those coincident indicators. These indicators measure the current economic state and give timely evidence of how the economy is doing. Classic coincident indicators might include weekly employment figures, workers' earnings, and auto sales. Lastly, for economic indicators that give confirmation of what's already happening, we call those lagging indicators. While you may ask why we would want to drive while looking in the rearview mirror, lagging indicators are useful to validate some large changes in economic policy or to disprove the effect of said economic policies. Sometimes economic indicators are lagging simply because of the time involved to gather the required value or data. Examples of lagging indicators include gross domestic product, GDP, or consumer price index, CPI. Again, not to worry if these examples are foreign to you, as we will drill down deeper into the economic indicators we touched on above, as well as many others later on in this course. In addition to understanding the economic indicators and economic events in general, it's important to discuss how the market classifies the sentiment of these events. You may often hear people talk about bulls, bears, doves, and hawks, so I think it's important to comprehend what these people mean when they use these terms. Firstly, bulls and bears. They're used to describe how markets are doing or how investors and analysts view the broader economy, the markets, specific asset classes, or even a market trend. A bull market is a market that is appreciating and implies that the market will continue to go higher. Bulls are people who continue to be optimistic. A bear market is the opposite. The market is falling and may continue to decline. Bears are people who think things will get worse, or pessimists. Hawks are people who favor less stimulus and higher policy rates in order to keep inflation in control, less concerned with economic growth. Higher policy rates are referred to as being tighter, as they restrict growth. Doves are the opposite, meaning someone who prefers lower policy rates in order to drive up economic activity and employment. They're less concerned about possibly inflationary pressures. Centrists are those who sit in the middle. Central bankers who are centrists are sometimes referred to as being moderates and tend to base their decisions on the most up-to-date economic data from their respective jurisdiction. One other thing to keep in mind is that there's a lot of economic indicators and economic releases that come out every day. And these economic releases and indicators run the gamut from the most important top-tier news to some things that are so niche that it wouldn't impact the average person in the market, such as Swiss watch imports change year over year, or Ugandan bill auctions, or the CPI for Puerto Rico. Here's a list of some of the more important events that you should keep track of. So far, we've talked about economic events, both economic indicators as well as economic releases. The question that you may have is, how do you find information on these economic events? Well, you could trawl through the internet or through newspapers and publications, but I'm sure you'll agree that's not the most efficient nor the most timely way of getting your information. Most market participants depend on their Bloomberg, which is a industry-wide platform for pricing, for analytics, for news, as well as trading that market participants depend on. So I'm going to show you how we find information on economic events using the Bloomberg terminal. So in order to find it, the shortcut is ECO Go, and that gives you the economic calendars page. It gives you the economic events that are due to happen over the next week, so in this case from the 4th to the 11th, including information that might have already been released that day. It gives you the survey, the expected amount versus the actual amount, as well as the prior, and in case of any revisions, it's also on here as well. If you're not looking at the US, or if you're interested in other countries, you can click under Browse here and choose whatever country that you may be interested in looking at. It also groups it by geopolitical regions. So for example, if you're an FX trader and you're focused on the majors, you can click under 15 and you can aggregate all the economic events for the majors together in one screen. Now, for example, this would be Norway's current account balance for the 4th quarter. You can look at, in this case, the Eurozone retail sales number year over year, and it'll all be on the screen. But for the moment, let's go back to the US, and I'll show you how we can sort the different type of data releases as well. So, first of all, you can click under Economic Releases here, and you can sort by economic indicators, which is releases in this case, events, which is, for example, the U.S. Federal Reserve releasing their Beige Book. If you click on central banks, it'll give you a list of which of the central bank officials are speaking. And as we'll discuss later, it's actually very useful for market participants to glean some information as to how the central banks are thinking. If you want to look at government auctions, for example, it will tell you what government auctions are upcoming for the U.S. Treasury in terms of their 4-week bill, 8-week bill, 3-month, 6-month bills. It's all on this economic calendar page. Now, let's go back to economic releases for a moment, and you can classify them by type. And don't worry, we'll go into all these different types later on in the presentation, and we'll talk about which of these statistics are most important. But I just wanted to give you a flavor of how you would be able to find that information using Bloomberg.